everybody, again with the derivatives and related accounting issues. In this video, we will discuss the learning objective number 4, determine and account for the intrinsic and time value component of an option. Before we discuss the accounting treatment of option, let us see what's option. Determine and account for the intrinsic and time value component of an option. An option represents right, not obligation, right, rather than an obligation to either buy or sell some quantity of particular underlying. It means that when we discuss future contract and forward contract, we have two parties. Now, each one of them has the right to pay or to buy or to sell something or currency, foreign currency or whatever, and he has obligation to pay the cost of this commodity or currency. But here when we talk about the option gives you right to buy or to sell, but not the obligation. You have option to write the commodity on the execution date or the option not to buy it. So this is the main difference between forward future contract and the option. When we discuss the forward contract and the future contract, you don't have option, you don't have the right to not execute the agreement. But here in the option, you have the right to execute it or not to execute it. This is the main difference. Common example include options to buy or sell stocks, buy or sell currency, buy or sell foreign currency, oil, metal, etc. Whatever you want, you can create an option to buy or to sell it. Here in the option, when we talk about it, we have two parties. We have holder of option and we have writer of option. Writer of option, he is the person that he has to give you or to sell you the product if you are talking about call option, or buy the product if we talk about put option. Let us distinguish between call option and put option, and then move to distinguish between holder of option and writer of option. Call option means buy option. We intended to buy foreign currency, we intended to buy commodity, we intended to buy, for example, corn, whatever you intended to buy it. In this case, from your point of view, it will be call option. On the other hand, the person who intended to sell you the product, commodity or foreign currency, from his point of view, it will be put option. The person who will sell, if assume or suppose that you agreed to sell $100,000 in the next 3 months or after 3 months. So in this case, from your point of view, it's put of option. You will sell it. If you intended to buy $100,000, it will be call option. You will buy it. If you intended to buy 10,000 tons of corn or whatever or wheat, it will be, from your point of view, call option. You will buy it. Now, strike price is the price of the goods that you agreed to buy it on the date of execution the option. So when strike price is greater than current price, strike price of the foreign currency, for example, 3.5, and it's greater than the current price, which is 3.4. Suppose that. So in this case, it will not be when you have call option to buy it, it will not be favorable for you. So in this case, we will call it out of the money. It will not be favorable. We are talking about unfavorable position. When strike price is less than current price, strike price is 3.5. We agreed to buy it. We have option to buy it by 3.5, but the current price is 3.6. So in this case, we will gain it. We will call it in the money. Otherwise, it will be out of the money. When we have put option to sell commodity, when strike price is greater than current price, so it will be in the money. When strike price, when we sell commodity and the strike price, the option of not the price of option, the strike price is the price of the goods that we agreed to buy or to sell according to the option that we buy or sell. The strike price of the commodity, for example, $1,000, and this price is less than the current price, which is, for example, 1,200. So if we have option to sell, so in this case, if we execute the option, it will be out of the money because we have loss in this case. So this is the pros of the option. In this case, we have a right to not execute the option. Let us move to the holder of option and writer of option. When holder of option, the person who holds the option to write or the right to sell or to buy. This is the holder of the option who will decide to sell or who will decide to buy on the date of the execution of the option. In this case, holder of the option, from his point of view, he has unlimited gain. If the price increase, as much as increase, so he will gain all of this amount. He will earn all of it. Suppose that the commodity, we have option to buy 1,000 ton by $1,000. This is the option. And the price increased to 1,000, 1,100, 1,200, 1,500. On the date of option, we will buy it by 1,000 only because already we have acquired an option to buy it by 1,000. So we have unlimited level of gain. On the other hand, what's the level of loss? The level of loss is limited to the amount of a premium, to the amount of the cost of option itself. Now, suppose that the commodity price that we agreed or the strike price of it is 1,000, but the prices has started to decline from 1,000, 900, 900, 800, etc. Now, on the date of option, we have the right to execute the option or to leave it. Now, the price or the current price is 800 and the strike price of the option is 1,000. Doesn't make sense to execute the option. We will leave it and or we will let it expire. So our loss is limited as the cost of the option itself, 1,000. Suppose we have acquired it by 1,000. From the writer of option, now look at the prices started to increase from 1,000 to commodity price 1,000, 1,100, 1,200. So in this case, he has to sell you this product. He doesn't has the option to not execute the option. He doesn't have any alternative not to execute it. He has to execute it. So his loss is unlimited. Okay, but his gain is limited. Here, suppose the prices started to decline from something, and he acquired or he purchased the goods by 900. He will sell it to you by the option by 1,000. So his gain is limited from 900 to 1,000. If the price coming less than 800 or 900, you will not execute it. For that, his gain is limited, his loss unlimited. On the other hand, holder of option has unlimited gain and has limited to amount of a premium. Let us see a numerical example to clarify what's the accounting treatment of option. To illustrate the use of an option, assume that call means we intended to buy option on 10,000 bushels of corn with delivery in April is purchased in February for a premium of 1,000. We purchased option to buy 10,000 bushels of corn by 1,000. This is the cost of option. We paid 1,000 to acquire option that allow us to buy 10,000 bushels on April 1st. We bought it on February, in February, and has a strike price of 2.2. Strike price means the cost of the partial is 2.2. If we execute the option, we will pay for each partial, we will pay 2.2. The value of the option at the end of February and March are 1050 and 700 respectively. At the end of the February, the price of the option has been increased to 1050. At the end of March, declined to be 700. It sold in early April period to expiration for 750. The relationship between the parties is as follows. Let us see the relationship. Here, option writer, the person who will sell us the 10,000 partial by 2.2, the strike price, and we are the option holder. We will pay them $1,000 as a premium to buy the right, to buy the option. That option gives us the right to buy 10,000 partial by 2.2. Let us see how we will record this transaction. The investment in call option and the changes or fluctuation of the option price itself before the expiration date. On February 1st, the date of investment, we paid 1,000. Against what? Against call option, the option that gave us right to buy partial by 2.2. So we have to record the payment, credited cash by 1,000, and investment in call option, that the right we bought is an investment. Investment in call option by 1,000, credited cash by 1,000 to record purchase of call option. Now, days move on, and at the end of February, the month we acquire option in, the option price increased to, as investment, the increase to 1,050. So in this case, we have gain on investment. You have to record it. Investment in call option has, as asset, has been increased from 1,000 to 1,050, and you have to record it because we evaluate financial instrument at market value or fair value. Investment in call option $50, increased by $50 because the price increased from 1,000 to 1,050. You will record it. And on the other hand, gain on option credited by 50,000 to record the change in total value of option. In the next month, in March, the option price has declined to be 750. Now we have asset. Option is investment, so it's asset. This asset has declined from 1,050 to 750. For that, we are talking about loss by 350. The difference between 1,050 and 700 declined. At the end of March, the price is 700. So we are talking about 350 as loss. Loss will be debited, loss on option 350, and the amount of investment, the amount of assets will be declined by the loss 350. So it will be credited. Investment in call option will be credited by 350. Now at the end of the month, before expiration date, we decided to sell it by 750. For anyone else, we decided to sell them. So anyone else will give us 750, and we will transfer the right to them, right to buy the bushel of corn. So we will collect 750, that the price we agreed to collect, 750. Against what? Against the investment in call option. Right now, investment in call option recorded in our book, debited by 1,000, again debited by 50, so debited by 1,050, and credited by 350, so we are talking about 700 balance of option in our book. But we sold it by 750, so we have gain on call option when we sold it. So cash will be debited by 750, investment in call option assets, and we dispose it by book value 750, and you have to recognize the amount of gain by $50. In this example, we have discussed the option contracts, option writer, option holder, and what's the accounting treatment, how we recognize, how we value, and how we dispose it. Let us move on to the coming learning objective. See you